All right, everyone. Good afternoon and welcome. Gosh, guys, we still don't have a name. I forget that every time we start this. Welcome to this podcast, where we've got a full slate for you today, including our focus, our feature, the man of the hour, Ben's trade of the week. Everybody, give it up for Ben. He's going to be our focus today, and his trade of the week subscription service which has done spectacularly well. Compounding, what has it been? Been like 10,000
Ooh,
into what?
I think we're in the
5,000 into
lower
what?
30s, upper 20s. Hold on, let me pull
Uh,
this up here.
so uh over the last year, he has combined some of his own stuff with some of my stuff and compounded it, and it's been just a tremendous performance for those
We
who
are
have
at
been taking.
roughly lower 30s starting from a 5K account in 2023.
There you go. So a couple of years, 5 into 30. Those are real trades, by the way, real actual fills, not hypothetical. So it is going to be something that we focus on today once we get past some of our normal stuff that we have to deal with, which I'm not even going to deal with the names right now. What I am going to deal with, though, is that, let's see, what is today? It's November 3rd. Friday was Halloween, and you can see that Spring still has her ghost costume on. So,
Listen, it's cold.
Spooky.
I can't bask in the sun anymore.
why? Because you're a vampire or what? What?
I mean,
Well,
we're throwing a lot of different
she didn't
costumes
deny
out
it.
here.
She didn't deny it.
Yep. Little bit of equipment issue there. So, if you have to get your sunglasses on to watch the podcast, we'll understand. We get it.
Overly
So-
critical father here.
whatever. I'm not even going to mention what you've said in the past on this podcast. So, don't
Talking
even
about your
talk
Put
to
your
me.
stinky
attention
pig
here,
Don't
guys.
even,
again.
Right here.
don't
So I
He's
even
got it.
talking
touch
about
There
his
you
me.
go.
stinky
Nice and
pig.
pretty.
Gosh, I don't know, guys. So anyway, we're gonna eventually get to Ben's trade of the week. We do have to talk about the market, which is still, it's not at all-time highs, but well, I blasted it is hanging on tough. So we'll get to that. Talk a little bit about compounding and then the workshop. And it's going to be something else. But before we get to that, let's talk about the market a little bit, because
Okay.
here we are. We're in November. We started talking about how the market was going to at least take a breather back at the beginning of October, and we got a 1 day move to the downside, and then it just blasted off to the top. All-time highs again. I'm looking for the chart. All-time highs again last week. In fact, we had the day we did the podcast last week, we rocketed up to 688 in SPY, and the week before that we were trading at 665. So so last week is when we had that ridiculous 200% annualized return in the course of like a 3 day period. We've taken a breather. It's Paquito. It's like really small.
Right.
And we're bouncing, as of right now, we're bouncing off today's lows. So what do you guys think? Are we ever going to take a breather? Ben, you're an
I think
expert on this. Chad?
what we actually called. I want to remind everyone we called a fantastic little dip there. I mean, we only got 1 day out of it,
We
but
got 1 day out of it. I can't even take
Semantics.
credit for that, quite frankly.
right. Um, but hitting the new highs again. It. What more can you say? I think the government shutdown, believe it or not, kind of puts the market at a bit of a standstill for itself. No data is coming out. Inflation's obviously the number one thing that is being looked at, and without that data supporting any of these cuts, I don't know if you saw the consensus from the last meeting. Obviously, the minutes are going to be released here. I don't know when they're going to do that, but it's usually a couple of weeks after. But overall, the Fed is not on board with these cuts, and they feel though that there's not enough data to justify there being enough fear.
So
Of course,
I didn't pay attention to anything that came out.
yeah. So they're kind
So
of
are you
divided.
saying
Yeah.
are they still talking about several rate cuts next year or
They're
no?
The one in December is up in the air right now, and that's gonna be a huge.
Really?
Yeah.
they're
So
are
there's
they
no
hinting towards a
guarantee.
pause?
Yeah. And
Yeah.
I personally think this is just a complete opinion. I think
Yeah.
they're going to pause. And if they do, I think the market may react negatively to it, even though it's
That,
December. I
that is
do.
I think
correct.
you might be right. I
That
think
is
you might be
correct.
right.
And
I didn't realize that they were wavering now,
Yeah.
yeah,
which is
breadth is weak in the
ridiculous.
market too. The overall breadth of
Oh
stocks in
yeah.
the market, a majority of those are below their 50-day, which is at institutional levels of, I don't want to get into all that, but the breadth, it's diverging from the market. I mean, the
Did you do that
market's going
research?
up, the
Did
breadth is diverging down. I think rates are already priced in. And to the point we just brought up, I think the Fed's hinting toward pause. And to Ryan, probably it sounded like agreeing, and Ben, we're not fortune tellers. I'm not an economist, but I think I've been bullish ever since we started this podcast, which is not long, 3 weeks, 4 weeks. But I do think that it's a four spring
5.
5?
five oh five. I think that there's going to be a little bit of a pullback likely. I
So
actually went short the SPY last Wednesday, got fortunate and hit the top and flattened out, but just on some timing mechanisms that I use. But anyway, that's my long rant on the market.
so if they're thinking about, but what, say I didn't even
Yep.
know this was. I didn't even think that that was a thing. If they're pausing or if they're even wavering on this,
Uh-huh.
after last week, let's see, today is so the high was on Wednesday, right?
Yes.
Thursday, Friday, Monday. Yeah. So the high
I
was
got
on
lucky.
Wednesday.
Yeah.
So on that, that means that this little pullback right here may be a little bit of a reaction to that. But see, on the flip side of that, you've got these trade deals that are going on with Asia,
Mm-hmm.
and they're not small,
Mm-hmm.
No.
right? So, man, there's just so many things. This is why I don't do fundamentals.
Right. I agree. Um,
And
you know,
so, what rationale only goes so far,
mm-hmm.
logic only goes so far. To coin or to repeat the phrase, the markets can remain irrational longer than you can remain solvent and all
Mm.
that. But still, we you cannot sustain a 200% annualized return over a 3 or 4 day period when the market's already at all-time highs. So I'm still there. I still think it's coming. The breather is coming. In fact, I kind of see this, and you can't. I mean, you really can't even call this a bear flag that's going on, but that's what it looks like,
Yeah.
right? Only we haven't moved down. It's a bear flag that looks like it's forming when the market hasn't moved down. And I think I said that on the live trade call this morning. That I think that we are if we haven't hit the top, we have come really close, and there's no way I'd be bullish this right now. So not that I risk a lot when I say these things, because I've been wrong more times than I care to count.
Yeah.
And so I always take positions where if I'm wrong, fine. I'm wrong.
But honestly,
Don't lose a lot.
even if one was off, right? And let's say the market
Yeah.
wants to push new highs again, I just don't just on a pricing, even on the valuations of the market, it's not going to go very far. It's just
No.
it just
And
can't. So I would still rather play it cautionary and wait for a better price versus going long, going with the crowd, or going with whatever is pushing this market higher and hoping for the best. You
yeah.
know?
And to Chad's point, breadth was horrible last week. Absolutely horrible. Like 85%. I read an article where it's like 85% of the stocks did not participate in the move of that 3-day move. And I mentioned that last week because my stocks didn't. Well, guess what? On Wednesday and Thursday, when the S&P was down, my stocks were up. So, go figure.
Yeah.
So basically, kind of like always, we really don't know what's going to happen.
Yeah.
But you're gonna take positions, and I've been telling people I'm bearish, but I'm hedged, which is exactly what you do generally, except to the opposite side, right, Ben? You're generally bullish with your positions with Ben's Teal trade of the week, right? You're generally bullish, but you hedge to the downside.
We do. On this last combo we did, we actually decided to take in a much fatter credit on a bearish side. And I preface that because I wanted us to make sure that we were positioned that if the market does want to take any kind of breather here, that we can get out of our bullish and reposition with a much more better cost basis and still hold on to that bearish. So overall, the position was bullish, and we actually had to roll. We actually almost was able to close out a gain on that when we initially put it on because I had normally I have us go out a week and a half, right, to expiration. For this one, for the Fed, I actually had us go out for that same week, that same Friday expiration to see if we could pull a quick reaction of sorts. But it didn't materialize, but it was fine because we got in at very good pricing. We got a very nice credit on the bearish. And as it stands right now, our cost basis, I think we're down 133 on the bullish that we had to roll, and we're currently holding on to our bearish. And as we speak today, the market's kind of flopping around a little bit to the downside, but nothing crazy.
Yeah, it opened higher today, came immediately down, and then it's been bouncing a little bit,
Yeah.
ever since. So, well, it's going to be an interesting play to see what happens over the next couple of months, no matter what, because we've got the most bullish week of the year coming up, first week of December. And if the market doesn't take a breather, there's no, I can't even commit to that.
Yeah.
I'm so skittish about what's going on right now, and long term, I'm still bullish,
Yeah.
Mhm.
right? So it's just that this is insane, and I don't need a big drop in order to do really well. In fact, in my live trade call, which I'm going to be talking about this in the workshop, and I mentioned the workshop earlier, but which, by the way, if you don't know, there's a link. If you're watching this, there's a link to the workshop. It's going to be December 10th, and it's all day. It's virtual, so you can be online. And the thing, it's all day, and I'm going to reveal 12 different option strategies. 12, a dozen, not one, not two, not three, a dozen. And I'm telling you, every one of them is worth the cost of this 1 day workshop. It's only $297 to attend. So this morning, I was pointing out something with my live trade crew about something I started last week that I've mentioned, I don't know, maybe a dozen times over the last several years as a way to approach this stuff. It's called profit stacking, and it's where you take like a trade that you're doing, Ben,
Mhm.
and let's say you're bullish, and then the market moves up, so you hedge that a little bit, and maybe you take care of the risk completely. You hedge it to where, okay, now if the market turns around, you actually won't lose anything. So what I do in some instances is if I can bring a position to risk free, I will put the position on again. So if I'm risking, let's say in SPX $1,000, let's say I'm bearish and I'm risking $1,000 with my position. The market moves down a little bit, I hedge it so that as the market moves back up, I don't lose anything. And as soon as I get filled on the hedge, I put on that bearish position again. So now I've got the same risk, $1,000, but now I have double the profit potential. And if that piece gets hedged, now I have no risk. I have double the profit potential, and I put the bearish on again if there's enough time left to do it.
What do you mean when you say you have no risk with your hedge?
So my initial position is bearish. So it means if the market moves down, I'm going to make money. If the market moves up, I'm going to lose a little bit of money. If the market moves down a little bit, but not enough time has passed, or it hasn't moved down enough, but I can put on now a bullish trade that if the market moves back up, I'll start losing on my bearish, but my bullish trade starts making money to offset the risk of my bearish,
Okay.
right? So if I can put both of those on, and the key is the timing, all right? You get the market to move down, time passes, you're going to get a better price on the bullish than if you'd placed it on at the same time as you put the bearish on. So you get a better price for the bullish. Market moves up at that point, and this is exactly what happened last week, by the way, because market was down and then it moved up. And I ended up, profit stacking the position twice. I had $10,000 gain to the downside and no risk to the upside. Or I say no risk, bid ask spread, maybe $100 of risk to the upside.
Now you said bid ask
Bid ask,
spread,
not
guys,
bid.
just so you know.
I did not.
All right. You
Now,
said
Ryan, are you
bid
taking Hey,
Thank you
Ryan,
for
are
that
you
clarification, Ben.
Ryan, are you taking profits to finance additional positions?
No,
Or
no,
no?
not
Okay,
no,
that's
not
what I was
taking
wanting to
profits.
clarify.
However, when I put on the hedging position, my bearish is at a profit. It's just not at the profit that I want to take it at. And so in order to hang on to that position, but take care of the risk, I put on a bullish hedging trade. And so once that goes on, if I've done it correctly, now I have got no risk to the upside, and all I can do is make more money or give back my profits that I
So
currently have.
what's the
Correct.
difference of this or with this and just increasing your trade size?
You add risk when you increase trade
Yeah,
size.
exposure.
Okay.
Yeah. So here I'm not adding trade size until I've taken care of the risk.
Gotcha.
And so the flip side of that is, sometimes the market doesn't move down. If my initial position is bear, sometimes it doesn't move down, it moves up, and I have to take the risk. Right? So there are times where you don't get to take care of that risk. You just have to realize that that's part of the game. But the way that I do it, and I am going to be talking about this in the workshop, and this process alone is worth 100 times, quite frankly, because so last week I was able to put this thing on. I had initial bearish position, $5,000 that the market made a small move down, like 7 or 8 points. That's all that I needed. And I make about $5,000 on a limited risk position. Market moved down, but it was early and it didn't move down quite as much as I was hoping. And it was early. And so you do have to have time pass based on my strategy. But I was able to put on the hedge. Then I immediately put on another bearish trade. The market moved down, and as soon as I could get filled on the hedge of that second one, I put on the second hedge. So now I've got 2 bearish trades that can make $10,000 if the market moves down 5, 6, 7, 8 points. And if the market moves up, I'm really not at risk except for whatever slippage I get on the fills on exiting out. So I exited those trades today because the market opened up this morning again. Got out of those trades and lost like $35. Whereas if the market had gone down 8 points, I was going to make $8,000, $10,000, 8 net after the hedge, right? So if you do that 4 times, if you're able to do this 4 times in 1 week, literally you can have a position on that has little to no risk, and never are you risking more than about $1,000 or whatever it is your initial risk is. But you keep adding on the profit potential if the market makes the move. So if you do that 4 times with exactly what I did last week, exactly positions, and I'm going to be showing these exact trades in the workshop, so you'll see what I'm talking about. But if you do that 4 times in 1 week with this particular combination, you're talking about a potential gain of $20,000 in 1 week with initial risk of $1,000.
So could you have flipped it and say gone bullish
Absolutely.
and hedged that, and so you would have made the money because of what the market did today if you would have switched it?
Um, yes, 100%, which is kind of what Ben does, only he doesn't. I don't think you profit stack, do you, Ben?
No, we typically stick to one side,
Yeah.
and we just
Yeah.
adjust as needed. Like right now, we're kind of in limbo, so we're just kind of sitting in an area where there's nothing to do.
Yeah.
But if we get a move where it puts one of our sides in a position where we need to manage it, then we manage it. So yeah, it's interesting you mentioned all of this because it's very similar to what we do,
Yeah.
Mhm.
Yeah.
just on a much more looser basis. It's
Yeah.
not as involved. I found especially yeah,
That's
go ahead.
going a little bit to the more complex side of it. I mean,
Mhm.
I think everybody, Spring, you understand the concept, I assume.
Yeah.
So if Spring understands the concept, trust me, everybody will understand the concept.
To the moon.
You had it coming. You had it coming.
You're lucky I'm confident.
No. So, my point being, I wanted to finish up on the workshop. Then let's going to focus on your trades, Ben.
Yeah.
Is that we're going to give the foundation in the workshop behind all my option trades, and then we're going to start building on that throughout the day. 12 strategies built on one another. By the end of the day, we'll be talking about the profit stacking, which you can apply to virtually any of the strategies once you learn how it's actually done. So something that you do not want to miss out. Click on the link. The seats are limited, and I do expect it to sell out. All right. So, Ben,
Yes, sir.
we talked earlier a little bit about some of my stuff, some of your stuff, and definitely some compounding. Give us a little bit about the mentality behind what you're doing. The uh, what's the word I'm looking for? The meat of it.
The meat.
Yes.
We've got the meat.
We've got the
Yeah,
meat. Oh, you
that's
beat me
right.
to it.
That's right. Yes. All right. So first off, anyone who's in my Tao, I love you guys. Appreciate you guys listening, checking in today. So basically what we're doing here, the market overall is going to trend upwards over time, right? Everyone knows this. It's nothing new. But what we do is we try to position ourselves to have our equity take advantage of the fact that the market is going to drift higher over time, but not worry about any kind of black swan events or any sell-offs that most people would end up trying to overhedge their accounts to the point where they're not taking advantage of any moves higher. So we
That's a
lean
great
our
point. We need to come back to that.
yeah.
So sorry, go ahead.
No, they're fine. We will lean on a bullish neutral bias, and we will keep, as most people would call it, a positive delta in our account. But basically, all that means is that we're basically long the market, and we give ourselves ample opportunity to take advantage of bullish moves. We take our gains, we're done. But if we have a bit of neutrality, which happens quite a bit in the markets, we'll then position accordingly whatever trades are going to be expiring or near expiration. We reposition those, and we still hold on to this to the spread, typically roughly about 2 to 3 weeks, and then we rinse and repeat. If we've got a sell off, which we did a massive sell off in the beginning part of the year on April.
Mm.
That's where we have a lot more flexibility. Believe it or not, I actually welcome those times because typically when we put on our bearish, that's going out roughly about 2 to 3 weeks in time, sometimes a month, depending on pricing. And our bullish trades are expiring in the near term. So if we get a move where the market's just selling off like crazy, that bearish is going to have a fat credit on it. It's got a lot of meat, if you want to call it there. And if we get a move to the downside, which we did in April, I had to stay on the sidelines for a little bit to see what's going on while we held on to that bearish, and then we repositioned again, and we're able to pull out a gain on that. Does it always happen that nicely when the market moves down? No. But when it does, it's great, and we love it. Typically, when we're going to see a loser is if we get sharp back and forths, right? So if you tend to manage your positions quickly, right, which is great, but if you tend to do it too much and the market tends to go back and forth like this, you're going to see a loss. Doesn't matter what the strategy is. If you manage too early and the market goes the other way, and you manage here, market goes this way, you're going to end up taking losses on the trades. And that's typically where we'll find a little bit of friction. But outside of that, if the market stays in a neutral position to a bullish position, we're golden. If the market wants to sell off, we're generally going to be golden. It's that, hey, we took a sharp move higher and then a sharp move lower, and then a sharp move higher. That tends to have a bit of back and forth that we try to stay out of.
So when you say on the bearish, if the market moves down, then it's got some meat to it. So you are trading a diagonal spread, then I would assume.
So on good question. So on the longer term, because we're trading Qs, the index ETFs don't typically allow you to go out unless you want to go to Friday. You can't do, say, a Friday to Monday, which is typically what we put on for our trades. You can't do Friday, Monday unless you go out a week and a half if you open it, say, on Monday of the previous week. So, for example, if today, you can only really the farthest you can go out on any kind of diagonal trade is going to be next week's Friday Monday combination.
Oh, they don't
Uh,
have in the queues. They don't go out further than
no,
that.
they don't go. They don't go out to. Yeah, it's the same way. If you
You'd
go,
think
they
I'd know
start going
that.
Friday to Friday after that. In fact, let's see if they
Uh,
change. This would be interesting if they change. I haven't
I
checked it.
man, I could have swore I
Let's
put
see.
together a trade in the queues not too long ago.
Let's see.
Now you've got me second guessing.
Yeah, hold on, hold on. 15. Yep, 14th and the 17th. So if we go out, like the next what would be a 14-17 combination. If you look at the 21st, it goes to next Friday.
Yep,
Yep.
yep.
So that it makes finding trades a little bit a little bit more cumbersome, but it's not the end of the world. So for those, and we've tried SPX on the program. SPX is a different animal altogether.
Mhm.
SPX would allow that flexibility, but we've decided just to stick on the index ETFs. It's what we know best, so we did it. I love SPX though. And at some point in time, there is some demand for it. I know some of my members absolutely loved when we were doing SPX trades, and we will circle back to those because some of the pricing opportunities there are phenomenal. But for the sake of the program as it stands right now, we stick with index ETFs, mainly the Qs. We were trading SPY for a bit. I love the volatility in the Qs. The Qs give us a bit of flexibility when the market's moving, especially on these spikes higher. We are able to pull out gains more consistently in the Qs than we were on the SPY. So we typically stick with the Qs. And our bearish trade is going to go out roughly about 3 weeks. And for that one, we're typically doing broken wing butterflies on that one. And how we structure the trade, if in this instance we're doing a bearish, we'll do a broken wing butterfly going out 3 weeks to 4 weeks and get as big a credit as we can get. And on the bullish side of it, when we're putting on those trades, those are going to be the cash flow trades that we put on. And that's basically the heavy lifting. That's what's going on there. So anytime the market does give us that move higher, we're cashing in very nicely on those cash flow trades.
So your bearish is not a diagonal. It's
Yeah, it's
okay.
not.
Okay. Got it. Got it.
Wait,
So
what's the difference between the multi-leg diagonal of the cash flow versus a broken wing butterfly?
Good question. So when you're looking at a lot of Ryan stuff, we do a lot of multi-legged diagonal spreads, which is cash flow stuff. It could be options insanity stuff, or just inverted. When you're looking at multi-legged diagonal stuff, it's going to have different expirations on the shorts and the longs, right? So your shorts are going to be in the near term. For example, you would have that expiring this Friday, and then your longs would expire the next Friday, right?
Mm.
And that's going to be a diagonal spread in its purest form. When you have something such as a broken wing butterfly, it's got 3 legs to it, but it has all the same expiration. And the reason why we do that is so I can go out and get a big enough credit on the index ETF, which won't allow a Friday, Monday expiration, for example. Now, we could do a Friday to Friday on that. I just, the pricing
that's
just,
where the profit bubble explodes to the downside
right.
because the volatility uh gets pushed into the longer term option if the market is moving down into the
Mm.
longer term put and relative to the short term put it explodes, which expands your profit potential. This is the way that you explained it. I thought that might be a diagonal just because of the fact that you're holding on.
Right.
But so a butterfly, condor, spreads of that nature all have the same expiration date.
Hmm.
So diagonal spreads, they have various names for all of this stuff, but
They do.
I'm just an expert on what a diagonal is because that's all you do.
Hey,
Oh, the harder
it's not
version.
all I do. It's
I
not
know
all I
it's
do.
it's the main bulk of what
Yeah,
you do.
yeah. In
Now, if you
fact,
were to give me a choice, I would love if we had the ability to do diagonal spreads on the bearish side with the index ETFs going out, uh, 3 weeks to a month. You could, but again, you'd have to go Friday
you're
to
you're gonna
Friday.
you're paying a lot for them. That's the
Yeah,
issue. That's
yeah.
the issue with
So,
yeah.
so to get that credit, we keep the expirations for the bearish side. If we're leading it as our bankroll, so to speak, yeah, we'll go out about 3 weeks to a month on that.
So when somebody gets your trades, you're not giving them the trades and then telling them what to do. I mean, you are telling them what to do, but it's simpler than that, right? You're not having to go put the trades together.
No, actually, we try to make it as easy as possible. So we've got the smart trade, smart share feature, where I'll construct the trade, and obviously depending on your account size, you'll have to make one adjustment on your lot size if you're happen to be trading more than one lot. But everyone's going to get the smart share that has the bullish side and the bearish side. And we use, which is my favorite feature in Trade Partner, which is the smart fill feature. And if you guys don't know what the smart fill feature is, it is awesome. It allows you to scale your trades in and get, I mean, basically the best kind of fill you can get without doing it yourself. So
Yep.
they'll get a bearish, they'll get a bullish, and I'll have them both execute a smart fill ladder order, which will basically have them both fill at roughly around the same time. There are instances, of course, I'll always put this in a smart share, make sure both sides fill. You don't want just one side to fill, and then, of course, you're naked on the other. But when they get the order, the only thing they're going to have to change if they're trading higher than a one lot is obviously the lot size parameter. It's say you're doing a 5 lot, then obviously you would change it to a 5 lot. But we make it as straightforward as possible for those that are looking for a little bit more about, okay, this is what we're doing. Let's fire it away. Bang. You got trade partner, you got your smart share, you're ready to go.
So
Hey,
trade,
Ben, if
so trade
somebody
partner,
doesn't
go ahead.
if somebody doesn't know what you're talking about, somebody has never done this before, they've dabbled in options. Do you think somebody with the materials that you've put together, be it in a PDF form or video tutorials, do you think people can learn what you're talking about, understand the jargons you've just discussed with smart fills and smart shares and things like that? Do you think within a short amount of time that a relatively novice um, option spread trader could kind of follow you and benefit from your mentorship?
Yeah, I think so. I mean, if you're new to options, it's not going to be for you. I'm going to tell you that right off the bat. If you're new to options, diving in with a program like this, you're going to be lost because you're not going to understand, simple things such as getting a bullish and bearish side filled or the multiple legs that we get into. So if you're new to options, it would definitely not be a program that I would suggest.
Not
However, a
without going
novice,
through the workshop first.
yes,
Right.
yeah, excellent thinking.
That's kind of what I
Which
was
you'll get
getting
more
at for
into.
people.
Actually, that's a good pair.
Right.
That's what I was getting at for people that are brand new and you feel like you're on an island, like what the heck has been talking about?
Right.
That's why I asked my questions.
Well, so
So
here's the issue is that I would say 90% of the stuff that we talk about is not discussed in other. It's we just approach things differently. From the compounding to trade partner, what we do in trade partner, and what we mentioned last week, the matrices, right?
matrices.
Yeah. The dead zone.
That is the right one, by the
The
way.
dead zone, right? So we approach things just a little bit different. It's not like we're reinventing the wheel or anything, but we tried to simplify as much as complex option strategies can be simplified. We try to simplify it. Part of that is through trade partner, which is where the smart order. So when Ben puts together his trade, if you have trade partner, which it's free, um, unless you
What's
want to
trade
actually
partner?
execute the trades, it's a trading platform, right? But if you just want the analysis, if you just want to receive trades and then go manually put them in on your own, you can do that through whatever trading platform there is. But with trade partner, Ben will put the trades together and then send you the file in what's called Smart Share. And so all you do is open it up. You can see everything that's there. Nothing is black box. And so you know exactly what Ben's doing. You know the prices. He's got a little bit of commentary there. And all you got to do is click trade. If you have Schwab or Tradier, and I think the programmers are working on getting us hooked up to TradeStation right now.
And
Right. So
interactive brokers.
Interactive brokers.
I
Cool.
mean Interactive Brokers. I didn't.
Yeah,
Oh yeah, not trade
so
station.
Yeah.
that's so to Ryan's point, so people understand, everybody that's out there in the internet world, basically it's a trade share, trade copier feature,
Yeah.
if that
Yeah.
makes sense, where Ben has done all the work for you, and it's a pre-filled trade that's linked to your broker, and you just amend one or two things, and it's pretty much already done for you.
Or you don't amend anything. You just stick with
Yeah.
a one lot. And
Yep.
And for those that understand what's going on, which I strongly suggest, no matter who you follow, what you're doing, I always push people to understand more, 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 more.
Yeah, no blind.
And so when you get that, if you don't like the trade, you can make a change to it, right? You just need to know
Exactly.
what the ramifications are if you do it before you make the change. So it makes it easy for those that maybe they're not brand new and probably shouldn't be taking it unless they want to learn. I guess that wouldn't be too bad, but um, it's something that is the easiest way to implement as possible if you have TradeStation Live or
Yeah.
Trade Partner Live. Why am I saying
What-
TradeStation?
Trade station
Ben,
over
with your
Bridge, there you go.
stuff, hey Ben, with your stuff, for a one lot trader, one contract option trader, what type of risk exposure might they have to stomach? A couple $100, three, four
Let's
hundred
see.
bucks,
In
five
fact,
hundred
let's give
bucks.
you an idea here. So
Okay.
looking at all of our trades.
Hmm.
Now, some of these, by the way, some of these were in SPX as well.
Okay.
Not a lot. It's a very small percentage of them. I would say, let's see, our largest loser, going back, buck 40 here, buck 65. A buck 65 was
So
our
it's
largest.
$165.
I mean, yeah, I mean, obviously, open position drawdown may differ, but we'll call it 200. Call it
So a
200.
couple $100 they might have to realize. Okay.
Yeah.
And that's to take a $200 risk in a $5,000 account that has grown over the last 2 years to low 30s,
Yeah.
Yeah.
30,000 to over $30,000.
Nice risk.
And Ben, one of the questions
Yeah.
that I would ask you if I was a trader is, on average to do one of these positions, how much capital, is it margin account, cash secure, just a margin account? And how much might I
If you can
need
get
to put up?
margin, that's one thing I will always tell people. If you can get margin, get it.
Okay.
There's
Yeah.
there's
Yeah.
there's no point not to get it. If you can get
Right.
the margin account, get it.
That's why I asked this
There's
question so people will know to request it.
absolutely. But yeah, I mean, you can set aside. My suggestion, I always tell people because we do get a question like that
Yep.
similar, oftentimes. I'll always tell people, listen, if you have $4,000 total, you might want to be a little bit leaner on your position. In fact, compounding is going to be a little bit more difficult to do that on the aggressive compounding because we have two compounding tables. If you
Correct.
don't want to compound, which you don't have to, stick with one lot,
But you should.
but you should.
Let's just
Right, right, right.
let's
You
just
should. But you can stick with the one lot, and I'll always tell people to stick with the one lot for a little bit if you're new. You got to get an idea of how I trade. If you don't like the way
Yeah.
I trade, that's cool. That's if you have your own bias in the market. If you have your do it. So stick with the one lot for at least 2, 3 trades. Get an idea of how I manage the trades, how we go about things here. But overall, I would always tell people you want to start with a $5,000 account.
Okay.
You can start with less, but I wouldn't. I honestly wouldn't suggest it. I mean, if you have a $5,000 account, which is doable for most, go for it. If you have less and you want to be more aggressive and you understand the risks involved, and as we just mentioned, you're looking at about a $200 loss on each. You got a hit rate of about, I want to say 66%. So,
Mhm.
a third of those trades are going to be, realizing that loss. If you're cool with taking that kind of heat, go for it. I'm not going to
Well,
say no to it, but
how much do you need to, because you said earlier you want to make sure both sides get filled. What
yeah.
do you need in your account to make sure both sides get filled?
Yeah, so you're looking at roughly, we typically don't break $1,400 in margin total,
Okay.
right? So the bullish, like the last bearish that we have on, in fact, let me pull that up right here.
Why don't you let's just talk about the trade.
Yeah.
Like
Yeah, so the last bearish
the
we have on,
strikes,
yeah, hold on.
expiration, what your credit was.
Okay.
That way we
Yeah,
can
so
kind
we've
of frame this
we've
out.
got a broken wing butterfly on the first trade. In fact, hold on a second.
People can Google that if they don't know what it is.
3 legs, same,
Yeah, we're gonna
same
go
expiration.
over it. We'll go over it.
Look at me, I listen.
You know what? Let me see. Those
know
trades
what?
are getting sent to me, right?
Yeah.
Hey Ben, how many trades might they have on at once? 2 or 3 different trades, or
We used to actually have on at times 2 to 3. I've actually cut that down.
Okay,
When we're in a combo, we're in a combo until it's closed.
gotcha. So 5 grand, I'm fine. Five
Oh
grand, I
yeah,
can do all the trades. So I wanted to know.
absolutely,
Thanks.
absolutely.
All right, so this is a bullish roll, so I do have them, and I'm going to open one up. So it's 1029 was the last one.
Yes.
We're just going to show these guys one of these here.
Yes, we had the bullish roll, and then before that, you have the actual main trade there, the one below that as well, where it says Tau QQQ.
Yeah.
Yeah, start with that one because I want to understand the role.
All right, let me share my screen here. And we don't get too far in the weeds, but we want to give people an idea
Right.
of what this looks like. So I'm going to share my screen. All right, so this is trade partner. And I'm just gonna go back to smart orders. So what happens is when Ben sends out a trade, it gets sent to my inbox in my account in trade partner. And all I gotta do is open it. So this is the last one that was started, right? 1029.
Yep.
So I can open it, and then if I want to take it, and obviously this is a ways out, but this one
Right.
was 1031, right? But so if I
Yeah,
want
we
to
already
take it,
rolled the second trade. The order 2 was the bullish.
yeah, all I have to do is say turn on system, and then it's going to follow this exactly the way Ben's laid it out. I don't have to touch it until he sends something else out, which is really cool. And obviously he gives some stuff. So here's the 622, 625. That's not the bullish side.
No, that's the bearish side. So we
That's
got the
the
bearish
okay.
on
So you've
that.
got the
Order
bearish
1 is
side
the bearish.
first.
Yep.
Okay, so you've got the bearish side first, and then on this one, shorter term expiration because this is going out 11/21, and then you've got a short term bullish. So that's why you can hold on if the market moves down like it did in April. You could hold on to your bearish.
Yep.
So that makes a lot more sense now.
So
Because
you
you're going out
exited your
further in
bullish
time.
already?
So yes, so we
Had
rolled
to.
this bullish a while ago already. So what we're doing here is that we took in about 1065 in credit on that bearish. And this bullish, which is order 2, was actually expiring last week Friday. I wanted to see if we got a move to the upside on that, that would have actually cashed in very nicely. If we got any kind of reaction, like a large reaction to the upside, it would have cashed in beautifully. I had us do this because it was cheap, so we got out of it. We only really lost about $1.30 on the trade. It's not a big deal. So now we have for the next 2 weeks, we got a bankroll of about 920 in that ballpark to play with in credit.
I was going to say too, Ben puts commentary up there if Ryan scrolls up. He
Yeah.
can kind of give you a couple, 3 sentences just to give you a heads up. Yep.
Yeah.
Yep.
So here we've got the bearish, and that's kind of our hedge, and it's going out until 11/21. So that gives you some time that you can just sit on it if you want. The bullish here, so this is order 2, right? So he has the smart fill. This is what he's talking about in smart fill, and I'm just going to show everybody this because it's one of the best things in any trading platform, and no one does it like we do. So the start price, this is a debit of 265. The end price is 3. It's going to go by increments of 5, and it's going to last 15 seconds. So what this is saying is that he's going to try and get filled on this bullish trade at a debit of 265. And that's going to put the order in automatically. You don't have to touch it. And it's going to hold it at 265 debit for 15 seconds. And if it's not filled, it's then going to move the order up by 5 points. So it'll go to 270. And it'll hold it at 270 for 15 seconds. If that's not filled, it'll go to 275, hold it for 15 seconds, then 280, 285, 290, and then 3 is the maximum he's willing to get filled on this. So if he's filled on the bearish and then he can't get filled on the bullish, what happens then? But you're pricing this so that
Right.
let's say the going price, and this is already expired, so we're not going to get accurate pricing, but the going price might be at 265, right? So you're
Right.
like giving it a really high probability of getting
Yeah.
filled.
There was one instance where we had gotten into a trade and the market moved very quickly in our favor, and the bullish side wasn't filled for one of my members, and
Mm,
there's nothing you can, I mean, there's going to be a lag from the time that we send these signals out to what you're doing during the middle of the day and what have you. And at that point, I told him just you got to close out because it had moved so far, and this was about a year and a half ago, I'd say. It had moved so far that there was, telling him to move his strikes higher from where he got filled on the bearish didn't make any sense. And because the bearish was going out so far in time, he really wasn't down that much because he had so much extrinsic value left on those positions. I had him close out, but it's rare.
yeah.
I price these wide enough so that when you get it, there's going to be a bit of a discrepancy. I'm expecting it from when you see the alert, from when you're able to execute it, from the time it hits your account. So, on this, I usually like to give roughly about a 10% give, up or down for from where it's at, in terms of the price. But sometimes I'll go as wide as 20%, just if I think there's a little bit more volatility involved, or to ensure that we're getting a fill. And honestly, if we make it wider, I can make the laddering. Instead of doing a nickel, we could do like a penny or 2 cents to make
Yeah.
it more fine. But then you also run the risk of obviously taking longer to get one side filled. So I try to make sure we jump in steps in good chunks so that both sides will typically fill at the same time.
Yeah. Yeah. So let's talk about being filled on the bearish and not being filled on the bullish. What's the risk here?
So overall on that one, I was risking about, I want to say about what, 550 in that ballpark? Top of my head,
Uh,
535.
so worst case scenario, you and this is still going out 11/21, right? So it's not like you're
Right.
going to suffer that loss
Mm-hmm.
immediately
Mm-hmm.
unless the market just absolutely skyrockets.
Right. Even then, because we're still giving ourselves about I mean, you're going to look at obviously a loss, but it's not going to be the full max loss on that. And
Right.
honestly, if you got into a situation, that's where a little bit of that discretion, comes into play, guys. If you are looking at these trades, you want to make sure that both sides fill, right? And you also want to just keep a cool head. Make sure that if one side's filled, make sure that other side is generally going to be the bullish. That's going to be the one that's lagging. Because I try to be a little bit more finer with that entry. Make sure it fills.
Yeah. And that's the thing is, this is a little bit more complex. This is kind of why you said this is not for absolute
Right.
beginning traders, even with
Exactly.
everything done for you, because you got to know, even though Ben's giving you a really high probability that you're going to get filled on both, it's not guaranteed. And if you're not filled on both, you got to know what the risk is on one of them, and you got to know what you're going to do if that happens. So, even I would say experienced traders should just watch it for a little bit before they pull the trigger, unless they really have a good understanding of what's going on. Um, but even then, this is like you can't get any more simplistic
Right.
as far as execution is concerned. To go in here and just say turn the system on and away it goes. So I think it's a tremendous thing. Is this typically what a trade looks like?
Yeah, pretty much.
Okay.
When we roll, we'll go ahead and you'll get. By the way, if you're not using Trade Partner, I also take the liberty of sending the alert out to Smart Trading, which is our portal
Yep.
that houses all of our videos and everything that we do. There is a section in there where it shows you the screenshot of what you just showed, and in terms of the legs we're getting into and that sort of thing. So, but yeah, that's typically what a trade is going to look like. You get the smart share, you get your bull side, bear side, and off you go. And if we roll a position, it's going to have a notice before we roll it that is telling people that we're rolling. So I try to give you enough time. So it's not this rush. You got to rush, 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 rush. If we're rolling a trade and I'm telling you, hey, we're gonna roll this trade, close out the trade right now at the best mid that you can get. Don't rush it. You don't have to go market order and go crazy. You
Mm,
close out that one side. In this case would be the bullish, and I will send you out another smart share with just the bullish side on it, and that's going to be the bullish roll that you
So you're
saw
just
there.
extending the expiration?
Correct. So that last one was expiring last week Friday, and this one is expiring this Friday
Hmm.
that we have currently open now. That one's actually a
So
bit more aggressive too for this Friday. That actually has a large upside to it if the market wants to venture that way. And it's actually only we picked that up for roughly about a little over $3, 3.30 in that ballpark. So even if we have a loss on that, we still are in our bearish bankroll if the market wants again take a tank. We're about $1.30 in cost basis from the first roll. And then if we have to roll this one, we'd probably be in a ballpark around $2 in negative. So it'd be about 330 to 350 in negative bankroll. And then again, we still have a $10 credit.
yeah,
So
what that means is that if the market tanks, you make $1,000.
right.
So on this first one that I just showed, if you get filled on the bullish at 265, the market tanks,
Mhm.
you could make $1,000 on the bearish and only lose 265 on the bullish.
Yep.
That's what he's
If you
saying.
did nothing, and that you're gonna obviously realize the full gain on that closer to expiration, right? So if the
Right,
market wants to
right,
tank tomorrow, right, we're not gonna see the full amount unless
right.
it's a violent move. I think at most, off the top of my head, you probably see about 80% of that credit, right?
Yeah, yeah.
And at that point in time, we can actually just sit on it because you'd most likely be in a gain, even if you didn't do
That
anything.
becomes your bullish.
Right.
Yeah,
Exactly.
yeah,
Exactly. I
yeah,
couldn't have said it better. That's
yeah.
exactly what happened. So we'd end up putting on a very, very cheap, bullish neutral, way out of the money to kind of cover that area where the bearish, which was bearish and we had it on, will start to lose money.
Yeah, yeah.
And then we just sit on it.
So very interesting. So how often do you put these out once a week, and then based on the rolls, there might be a midweek
Right.
type. So it's not like super active,
No.
right?
No, in
So
fact, I've noticed that when early on, we used to put on a trade sometimes twice a week. And I started seeing that oftentimes, life gets in the way with some of the members. They've got things going on, and
yeah,
they actually wanted less trades because they would prefer to put something on, and just manage it, check on it once a day, once a week. And I've found that there's a happy medium between, because you do have to trade, a decent amount, guys. Don't forget that if you trade, you don't have to churn your account where you're just spilling out commissions left and right, but you definitely want to trade enough to make it worthwhile. You
yeah.
want to obviously keep your account active. So I found that doing these combinations gives us pretty much the same yield versus doing a trade once a week, twice a week, versus doing one that goes out 3 weeks and then we manage it. The yield is very similar.
So
So it's
you
an
do one trade every 2 or 3 weeks, not
Well,
once.
it's one combo roughly every about 2 or 3 weeks, and then we manage it in the middle. Oftentimes, it's just great if we put on a combo week one and the market just goes our way, we close out, we're done, and we'll do it in the same thing the following week if pricing is there. If the market wants to stay back and forth, we'll typically have to roll one side, and if the market sells off, we'll definitely have to roll one side, the bullish side, and then rinse and repeat.
Okay, so you're
which
telling
is paid
me,
for basically.
Right.
hold on.
Yeah,
You started 2025 with
2023.
no, I'm looking
Oh,
at 2025.
okay.
With around 7,500, almost 8 grand in the account.
Right.
And by doing one, maybe 1.5 trades every 2-ish weeks, maybe 3 weeks, you've compounded that to 32 grand.
Yep.
That's
Good
unreal.
winners
Like,
in
the
there.
amount of work
I
that
think Spring's going to subscribe now.
no, just think about it. That's not even a whole year. That's an 8 grand account. And the amount of work it takes on a computer to click turn on system, adjust the trade size, and it's just free money.
We can't say that.
We can't say that.
We can't say that.
It's just
Only the-
like
Past
free money.
performance
I mean,
does
no,
not
obviously
guarantee
there's risk.
future.
Obviously there's risk. But when I look at those numbers, that's remarkable. That's super cool. Like, because I think about it, oh man, I could throw 8 grand in an account and start trading. While I know there's always risk, always, 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 and there's no guarantee that it's going to continue. I understand that, but it's beautiful. I'm very impressed.
The way that
Thank you.
the way that
I
the
will say
trades
though,
are
it's
put
an
together.
aggressive. Okay, Ryan.
Yeah.
Sorry. Again.
Yeah, the way that the trades are put together, are designed to continue performing under most market circumstances.
Yeah, that's awesome.
Similarly,
Mhm.
right? So there are circumstances that can, throw a wrench in the wheel, so to speak. There are instances where, you turn it on and you're not filled. Or I'll tell you an issue that I've run into with my own trading, um, that if I'm not paying attention, the order's rejected.
Oh,
Yeah.
And it's because I have these other positions on, I have other
Right.
spreads on, and there happens to be a contradicting strike price
Like a
and
leg, right?
expiration date
Yeah.
in one of my new spreads. And so I hit click and I walk away, I hit execute and I walk away thinking it's going to place it, and I come back later and it was rejected. Right. So there are nuances and things like that that can happen, that especially for beginners, if they don't know what to look for, they aren't
yeah.
diligent about looking at, making sure that the order gets placed properly and it's filled, and they check the smart order. And so there's still some responsibility, and there's still some things that can happen. But the way that the trades are put together, they're designed so that the probabilities long term are, in your favor. And let's not forget, I'm going to just punch this in here, that the majority of those gains are from compounding.
Yeah.
It is not because the strategy itself is just this, spectacular, massive profit producing strategy. It's a little bit of money consistently on a weekly basis, more or less.
Yeah.
And it's an
And
aggressive compound too.
And
So
it's an
can,
aggressive compound.
it is.
I'm going to ask a question. And I think it's an important question that people might not realize if they're new to trading, been around a long time, is talk about the peace of mind in this strategy. I
Yeah.
mean, are you
Yeah.
panicked? Are you worried? Are you stressed? To me, it's coming across as, it's a lower kind of psychological stress, because if you've been trading for any amount of time, there's some trades and things that can keep you up at night. So Ryan's giggling. He gets what I'm saying. So
Well,
Ben,
you know what's an interesting thing too? I try to point out
yeah,
whenever anybody asks about the compounding, right?
yeah,
The number one thing I will always tell people is that you have to be prepared for a larger drawdown on a percentage basis, because you're more aggressive with your money. When you do hit a drawdown, you're gonna be scaling back at a larger rate. For example, right? We had at one point in time before the 2025 that Spring was mentioning at the start of this year, we were at a 13 lot and we are at a $12,000, roughly about a $12,000 compound. And then we had two sizable losers, and at the beginning of the year brought it down to 7,800. So we had to scale down.
which is a 50% peak to valley equity
Right.
drawdown. If you have a $500,000, can you do that? If
I
you
wouldn't
have
say
a
if you
million
have a
bucks,
$500,000, I would always tell people you need to be more conservative with your compounding.
Yes.
right?
Yeah.
I think oftentimes people will say, "Well, I got six figures in my account. I'm gonna hit it. I'm gonna hit it big." It becomes different. The emotional side, the psychological side of trading gets more difficult the higher the lot size you're trading. And really, there's no sense in being overly aggressive. You can be aggressive with a smaller amount and then just turn the heat down as your account grows. In fact, now that we're sitting at around 30, once we get to roughly around 40, I'll probably turn the heat down a little bit, and we'll switch over to a much more conservative account size, rather a compounding schedule.
So you know
So,
what we should do?
mhm.
We should just carry this on into the next podcast and
Yeah,
make the next podcast focus compounding,
Fair
because
enough.
it's so
that'd be
important.
great.
And this is a great example of live actual example of different ways to approach it. And for those that don't understand what I'm talking about, I think I want to share the screen again just real quick so I can
Yeah.
cover this real quick. But let's see, advanced. All right, so here he has a one lot. This is a trade size right here. It's a one lot on order one and order two. What does he mean by compounding? So once you have put on a couple of trades, let's say you're up. What's your delta that you're using for the compounding
The
equation?
aggressive one is a 75. The conservative is 500.
$75.
Hmm.
That is pretty
Because
aggressive.
it
That
is
is
very aggressive. And that's why I
all right.
tell people from the beginning, you need more margin
Yeah, if you're
than
going to be aggressive,
absolutely.
yeah. So
Okay.
What does delta mean?
we'll definitely cover that. We'll
Yes.
cover that.
Yeah,
We'll
because I'm
cover
gonna
the
need to know why
equation.
you were so shocked. Because that didn't mean anything to me, you know?
He's
Um,
not talking about option delta, by the
so
way.
it's actually not that bad. If his largest loss has only been $175, that's actually not that aggressive from the standpoint of what the risk is. But from the standpoint of the account size, if you're taking a $1,400 margin every time you put one of these on, you're going to be up above.
Right.
Your margin is going to be bigger than what you have
Then
in
the
the
account
account.
size is right.
Right.
Exactly.
Ah,
So there's ways around that, and that's just to start bigger and plan for the growth. But you're not risking anything more. You just have to have a little bit more in your
Right.
account to start with. But
Exactly.
what that means is that when he gets to a certain amount of profits, if you're aggressive, $75 would be your first profit level. If you close this out for more than $75, you're going to, on the next trade, take a two lot. That's what that means.
yeah,
Right.
And then if you lose and you lose the maximum loss, let's say you lose $175, you actually lose $350,
yeah.
which means you have to drop back down to one. And that's the hardest part in compounding. It's going from one to two, two to three,
Yeah.
because you can
And that's
drop
why you
back
saw
so
that big jump there
quickly.
when we had that loss
Yeah,
before 2025 is because it's so aggressive. We had to scale back down to like I think it was a 7 lot or something like that.
yeah,
And but then it recovered shortly after that because it was so aggressive. So if you can handle the heat, go for it. I would say honestly, it's better to take a smaller amount, be aggressive with it, than take a bigger amount and be aggressive with that. Because if you happen to start, and again, this is all strategies, guys. If you start a strategy or program and you happen to start right when it gets into a drawdown, you know, you're in for a world of hurt.
yeah,
Because if you start big and you take two, three, four losses in a row, you know, it's going to hurt. So it's always best to start with money that's manageable, something that you obviously are not going to lose sleep over, and compound it. Be aggressive with it.
yeah. So what I tell people, like to Chad, what Chad was saying is, you get up to $30,000, and then you suffer a couple of losses. You're talking about, going down, 7 grand
Yeah.
type deal.
Mhm.
And while that's hard to swallow when you're not there, and quite frankly, it's hard to swallow when you are there. What I always ask people, because you're going to go through the drawdown, right?
That's
Whether
right.
it's one lot or 10
Yeah.
lots. And if let's say without compounding, let's, what is the account without compounding? What would that be
It's
Let's
at
see.
approximately?
it's at 9 grand.
It'd be
Nine
like
grand
40
without
something
compounding.
percent.
7,600 to
Yep.
992.
91.35 roughly.
10,
Okay.
20, 30. Is that 30%?
What for 9 grand?
Yeah,
From five to
7 to 9,
nine?
10, 20,
Oh,
1400.
I was talking about starting account size at
Oh
five,
yeah, right.
Oh, sorry.
going to nine, right?
Yeah, it was 7610.
So, what so let's say you get to 9 grand, you're still trading one contract, and
Yeah.
then you go through and you lose, let's say, $500 on a couple of trades. You take two losses, lose $500 on a couple of trades. So you're down to 8,500, right? Whereas compounding, let's say you get to 32,000 and then you drop 8 grand. So you're at 24,000. I always ask people, would you rather have an account size of 24,000
Right.
or 8,500?
Yeah.
Right.
That's
So
right.
yeah, it is bigger, but it's bigger.
Mhm.
That's right. Absolutely.
So
There it is. That's a t-shirt idea, guys. It's bigger, but it's bigger.
So Ben,
Exactly.
I'm not even acknowledging that. Uh, so I'm looking at your track record right now. And I noticed, so you said 2023, but I noticed you restarted.
Yes.
Did you restarted at
Yeah, we
5K
restarted.
at
Yeah, we were
2024?
yeah, I decided let's start fresh because in 2022 it wasn't the same service. This was more I think we were doing a little bit more of a testing thing back then.
Mhm.
I didn't want to taint the numbers. So when we officially launched the program, decided to start fresh in 2023 with that one. But yeah,
So why does it take so long to build the first like $3,000?
you know that's
That's a
math.
great that's a great
That is a
question.
great question. That is a very good question, and that's a lot of that is tied to psychology, but the main answer is
Mhm.
math. It's going to be a
It is
lot
math.
longer.
The slowest growth in compounding is at the front end,
Mm-hmm.
always. And
Always.
it's because it becomes geometric.
Yep.
Right.
And so you don't have that geometric effect in place at the beginning like you do at the end, which is why I tell people you got to start compounding and just stick with the compounding because it's going to take a while. It might take you a year, right, to get up to any kind of substantial trade size. But once you are there, the growth just starts taking off and it becomes nuts.
Hmm.
So that's it's a math thing.
Mm-hmm.
And also the greatest, it's something called asymmetrical leverage. And I don't want to steal next week's, and we're probably already over time. So I don't want to get into this in too detail, but this is my shtick, right? Asymmetrical leverage happens the most at the beginning as well. And so the compounding is hardest at the beginning, which is why I say, if you've got experience with something and you've been trading it and you kind of know what to expect and you're not going to get taken by surprise, there's nothing wrong with starting with a 3 lot, a 4 lot, a 5 lot, and going
Yeah.
from 5 to 6 and then 6 to 7, 7 to 8, because the asymmetrical leverage effect is not as detrimental if you suffer a drawdown with a lower trade size at the beginning. It's actually, bigger on the asymmetrical leverage, which we'll talk about asymmetrical leverage in the next one. I don't want to get into that right now, but I did want to mention it since you asked the question. So
Sorry, just thinking.
yeah. So I think we can pick that up in the next session. I do want to mention a couple other things. Where are we at on time, Ben?
We are about an hour in. Did I say that
Okay.
right?
We'll wrap this up pretty quick. But we've got something else launching we've been talking about coming up. And even though we're not launching it to the general public, you're going to want to watch the videos when we send these videos out. And it's on TradeHound, which is the background of our what are we doing? We're creating a brand.
I didn't know where I was pointing,
Right?
guys. Sorry.
Hey, you did a perfect job. It was great. It was
You actually
great.
pointed to it. Yeah.
I did. I
Yeah.
got it right the first time.
See, I don't have to worry.
Right.
That's right.
I was just
everywhere.
thinking that. Like, I can point anywhere.
Got one dog. You're just staring at me, lady. Just staring at me. Oh.
Yeah. So TradeHound, I ran in. I mentioned this a couple of weeks ago. We moved up 8% in 3 months in SPY, and I put that into TradeHound. I said, okay, what does the market do when it's been up at least 8% over a 3-month time period? Anyone want to guess what it does?
If it's been up 8% or more in a 3-month time period,
Yep.
Surely it doesn't just tank.
a
Not
continuation
tanks,
move.
but it doesn't move higher. I'm going to go with that.
Bingo.
Maybe it just plateaus.
Within about 10 days, the market moves down approximately 75% of the time. And
Wow.
and then the longer you go out on how long you hold the short position, the smaller it gets, and eventually it turns into. So there is what I was saying, and I tested it out in TradeHound. There is a breather that is normal after these types of moves higher, and that's what TradeHound will do. Is it will actually give you stats of previous market action based on certain circumstances. Now, this is the beta version that we're releasing, so it's very simplistic, and AI is just not where it needs to be, quite frankly. There are still just basic mistakes in AI
Yes.
across the board, and we have to deal with those. It's not that the mistakes are ours; it's that just the nature of LLMs, large language models, which is what all AI is. It's just not where it can be relied on without double checking or without creating errors. And I mean some of the most basic errors. So Granted that there's that. 2 years from now, I think they're going to cut down on the errors by like 90%. I mean, it's going to be spectacular, but you don't want to start 2 years from now. You want to start now. And so just be on the lookout for TradeHound. It's the AI for trading. And we're delving into that world. So
I think we're all going to have to start learning Polish. Did you hear about this, Ryan? I saw an article.
what?
And we'll wrap it up on this. And apparently Polish is the best language to prompt AI. Can you
Nope.
believe that? Apparently they're saying
Was there
that
any logic behind that?
there was some study. I didn't go in depth on it. There was some study that said that the Polish language is the best language to prompt AI, that it makes more sense for the AI to
Maybe
hear a
it's
Polish prompt versus
maybe
any
it's
other language.
the language is less contradictory because I have
Possibly.
young
I have
children.
no. I don't
I'm
speak
teaching them
Polish.
Okay,
phonics.
so
Think about
no.
phonics. It's the worst thing to teach in the world because yes, this is a rule. Oh, no, it's not actually a rule for this word. Like imagine being an AI, like just a little kid learning that. It doesn't make any sense. It's
Yeah.
ridiculous.
Yeah.
So
Any of our listeners out there that you speak Polish, I'd love to hear your take on that. If that's inaccurate or if it's something that
So I don't know where you're getting I don't know where you're getting your
it was an
information
article. It was
from,
just an
but-
article that came up on my feed. Because I get a lot of language model articles and
So I've got a
stuff.
question for this.
Yeah.
I've got a question.
Mhm.
So if I tell ChatGPT, here's my prompt, now translate it into Polish.
Oh, interesting.
And then I say, okay, then I paste the same Polish translation that it gave me.
it depends on if it can translate it
Here's
properly.
it.
That's less complicated. It might not translate.
Here's
your
what we can do.
Polish
Here's
into
how we test
Polish
this.
correctly.
You give it a simple task, right? You give it a simple task. You get from point A to point Z, and you've completed it. Then you tell it to summarize that entire task in one document in Polish and go to a different language model and then take that document in there and see if it can get right to the same point in less time.
So is this across all platforms? I can't imagine that it's across
Right
all
now, it
platforms.
says
I'm reading about it.
ChatGPT.
I knew you were
Did you find
researching
it, Chad?
Chad.
Did you find it?
Hang on.
Yeah.
Yes. Yes.
So I'd
Okay.
be curious to know if we have any listeners that are fluent or at least speak a little bit of Polish, what the idea behind this is, because I can't understand why it would stand out as the best language to prompt AI, but again, I don't speak the language, so I have no idea.
So the takeaway from this is that we all need to learn Polish to use TradeHound.
No. Just Chris.
That's right.
It'll do the back end work for us.
Or we just need a good translating AI.
That's it. That's all we need.
Yeah, that's ridiculous. That's ridiculous.
Trans.
All right. Well, we didn't get to talk about one thing that I really wanted to talk about. So
Oh, I'm leaving.
we're not gonna talk about it.
We're
today.
gonna talk about it.
No,
Can
we're
we
not.
hint
Because
at
We're
it?
gonna
We're
talk about
done.
it.
We're
Yep.
done.
Nope. All right.
No,
I bet
we're
everyone
done.
can guess what we need to talk about today if
Yeah,
they follow college football.
We need to talk about it next week. I need
No,
to
it is
open the
fresh.
wound up again.
Who do you guys
Let
play
me
next week,
say,
Ryan?
What I wish
What is it?
I'm
It doesn't
gonna
matter, Chad.
No, you know what I'm gonna have Ben do is I'm gonna have him pull the cut from last week's podcast and throw it in here and put exactly what you said about how Tennessee was gonna beat OU.
Hey, you know
And
what?
then we're gonna see that Tennessee did not beat OU because I'm a loyal fan.
Did Ryan
right,
have to
listen.
wear something if OU won spring?
No,
Yes.
no. Well,
Yes,
first of all,
absolutely.
everybody's
He
gonna
just
get
got finished wearing his
confused here.
Texas shirt.
Every-
So, from another faulty bet he made. That was
I
when
am
you
an-
were actually loyal.
I am loyal.
He works on probabilities, guys.
People are going to be confused by what you're saying, Spring. They're going to think
Well,
that I
you're
was
gonna
a
have to give
Tennessee
him
fan.
some back.
I am a
background.
Sooner fan through and through, but I'm realistic. I don't have my heads in the clouds up here about how wonderful the Sooners are
Realistic,
this year
and
because they're
yet
really
won.
not that good. All right, the defense is okay. The offense,
3 turnovers. Defense was great.
oh, come on now. Some of that was Tennessee.
Oh, no,
Right?
no.
Don't get me started.
No. That was OU's wonderful,
Whatever. Anyway,
wonderful
I'm not blind.
defense.
right? I trade. I have to be absolutely objective
There you
about
go.
what I'm putting on. And I am the same way with how I approach college football.
Cop
So
out. Hold on.
I saw
Hold
a
on.
ball. A ball was thrown. I called a ball. It wasn't a strike. I called a
No.
ball.
There you go.
Now hold
It
on.
happened to be a strike.
We're gonna have to go back to the background of your bet about Texas because you're a realist.
That was before I knew the offense side.
Okay, so what he
Right.
did, we have a cousin who's a
Mateer got a
diehard.
broken thumb. This was
No,
I made the
no,
bet.
no.
I made the bet before Mateer got a broken thumb.
What was the bet? That OU would beat
That
Texas.
I would have to wear a Texas shirt for 4 Saturdays in a row if OU lost to Texas.
Second year
And-
in a row that he's had to wear a Texas shirt 4 Saturdays in a
All
row.
right, no one cares about this.
See
Trust
that? There
But
we
you
go.
voted
Trust me,
against
no one
them
cares about
or
this
against
except
OU,
Texas
Tennessee.
fans. And Texas fans are charged double for everything that we own.
Yep,
So
there you go.
if you're a subscriber and you're a Longhorn fan, expect an invoice in the mail. I'll get my revenge.
Oh,
We're going to talk about you next week, Chad, though.
You're
All right,
up.
guys.
Love it.
Hold
You
on.
guys.
Make sure you like and subscribe. I forgot to tell you earlier.
Yes, yes. Everybody like and subscribe except Texas fans.
No,
Just send us some money.
we don't.
That's right. Cash, preferably.
Cash.
Oh boy.
All right. Like and subscribe. We're out of here. Everyone have a wonderful day. We'll see you next week.
See you next time.
Bye.